Hey everyone, welcome to today's edition of The Final Bar. We're going to talk market recovery. I feel like every day we're talking market sell-off, market rally, never kind of in the middle these days, right? So we're going to talk about the nice reflex rally we've had today, led by utilities, consumer staples, so sort of an unusual reaction to what we've seen in recent weeks. My guest is Tim Taschler from Sprott Global, who's going to help us think about the gold markets as a potential safe haven. We'll see, and we'll unpack all of those themes and more. Ladies and gentlemen, this is The Final Bar. Hello, everyone. Today on The Final Bar, it's going to be recovery day. And so should be fun breaking down the market environment. My name is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com. Thanks for joining us every weekday after the close to try to make sense of this volatility, try to understand how the short-term move today fits into the long-term. And no better time than in this sort of environment to have a proper long-term perspective. Really think about how these moves relate to the longer term trends, the longer term inflection points. Today it was all about a bounce back, right? We sold off out of the open, but then most of the day showing more, constructive than destructive. But the leadership picture a little interesting. So you had some of the defense up on the top, but then something like technology, and at the bottom you had things like consumer communication services, and then energy, which has been one of the consistent weaker parts of the market. We're going to look at gold as well. And I think, when we're thinking about gold, there are a lot of different ways to sort of think, but I think a lot of people, and probably myself included, oversimplify. I think of gold as a safe haven. My guest, Tim Taschler, is going to help us think about some of the ways you can break down gold, and again, whether or not it is operating as a safe haven, or maybe there are other layers to that analysis that we want to keep our attention to. I did want to point out the schedule coming up on the show. We've got a lot of really good content coming your way. Today, we actually released Larry Williams did a special, very bullish special talking about a market recovery. And on one day so far, Larry did a pretty good job of identifying that. So I wanted to point that out. Jeff Huge also did Behind the Charts on Monday, which was pretty good discussion about his background. Coming up though, in this week, we have David Auerbach tomorrow on Wednesday, and then on Thursday we have Cliff Drokes. There's some really good guests, including Tim Taschler today, to help us try to make sense of this overall market environment. Let's get right to our market recap. So did the TD Ameritrade Network this morning. I was interviewed on their morning show, and I wanted to share with you 3 charts just to start off that we reviewed that I thought were most important as a great way of making sense of the long-term trend. Then we're going to get to today's price action in particular. The first chart was this one, which was looking at the percent of stocks above their 200-day and above their 50-day. So we have less than 5% of the S&P above their 200-day going into today. The last time that has happened is going all the way back to the 2008-2009 bear market phase. And what's interesting, I thought was most telling about that, is when we went below 5%, that was at the beginning of that sell. That was on that first big impulse move down in October of 08. It wasn't the bottom in the spring of 09. It was the initial push down. And so I think that, along with a lot of the other breadth and sentiment reads we talked about, is what supports this as a bottoming process where I feel like we're still going to see lower lows based on that sentiment, that breadth reading. The second one was looking at the S&P, and this is getting into just today's movement on the S&P. We'll update it for today. So I'll say we had a nice reaction move, a nice bounce out of the lows. It looks eerily similar to Friday of last week. We had Thursday's big sell-off, but then Friday's reaction putting us back above 2,700. Monday, we go back again pretty deep at 2350 level we've been talking about in the show for the last couple weeks, really, as we first sold off. But all of a sudden, we went up, almost closed above yesterday's high. So there's a huge amount of volatility. What we focused on this morning that I would point out is this potential bullish divergence, right? We have lower lows in price, higher lows in the RSI. What concerns me about that is if you're doing that now, you're considering this low to be established. And when we looked at it on Thursday and Friday, it also looked like a bullish divergence. The problem is the price keeps going down. So what you want to make sure you wait for in this sort of environment is an establishment of a lower low that's some sort of a level you can believe in. And just based on the volatility, based on how much we're fluctuating, I can't guarantee that today's low is going to be the low, or that yesterday's close is going to be the lowest close during this sell-off. Tomorrow might be another big down day. I'm not sure. So what I want to do is make sure that a lower low is established. It's a firm low that I could draw a line on, feel pretty confident that that's going to stay, and then I can look at the divergence here and identify it. What I would also look for is the RSI to break above the most recent swing high, which was here around 43 or so. If that would happen, that would mean the price is pushed up enough that it sort of validated that bullish divergence. Haven't seen it yet, though. And then the third thing, to get into maybe some of the sector work, it's worth noting that technology has been a consistent outperformer in up markets as well as in down markets for the last 14, 15 months or so, right? So from the market low in December 2018, price has been up, price has been down, but overall the trend in relative strength on the XLK has been consistent. I think a big reason for that, it's been a mega cap tech-led, bull market phase. We know how mega caps, large caps keep leading over mid and small caps. I think today we saw that again. And what it means is things like Apple and Microsoft, which years ago would be thought of as more of the speculative high beta environment, they're more the stable blue chips that you might have thought of in other sectors before. It's in tech, right? So those big tech names have some staying power. And even though they're down, retracing 61.8% of this overall bear market phase, it's actually still holding up on a relative basis. So those are three charts I think that are worth, put sort of all of this in context. Today, though, it's worth noting the S&P was up 6%. Small caps actually led even more. They were up 6.5%, which is incredibly unusual. Mid caps down a little less, just over 5.1%, but all in the green. The VIX still very elevated, but down around 73, 74. In terms of sectors, you have utilities really leading the way, which again, a big up day led by utilities and consumer staples. That is not the raging bull market sort of environment I would have in mind. You would want things like consumer discretionary and industrials and other things to be up here. So it's some of the stuff that makes sense based on the coronavirus fears, things like staples doing well. That kind of makes sense. And technically, there's some very good charts within staples. But there's tech that we just talked about, number 3, followed by real estate. At the bottom, we have energy, which has been a dog for a long time, but continuing to drag on the indexes, followed by consumer discretionary, then communication services. So it was not additional offense versus defense type of move. It was more, stocks that are working are up at the top, and stocks that aren't are down there at the bottom. In terms of some of the global markets, you saw things like Brazil up big today, also India and Spain. So there's some markets that are actually up decent amounts, 10, 12% at a clip. Not very many things down. Canada was the only market that was down, followed by Singapore, Germany, and Italy. Some of the European countries certainly struggling with all the macro themes that we've been talking about. In terms of groups and industries, I just point out a couple of them that I think are worth identifying. You see within utilities, the reason why utilities did so well. Look at some of these groups and how well they've done today. So you have multi-utilities, conventional electricity, things like gas distribution. These are groups that are not sexy, are probably not names that you know, but there are names that are doing very well. Water especially up 16%. So if you're not familiar with some of those groups, you haven't paid attention to them, it's a great opportunity to take a look and see what sort of names pepper in. I thought it was worth noting that semiconductors are actually up 10% today. They're one of the best groups out of the 100. That was the top 10 performer, which is pretty good if you're bullish and are looking for some upside. On the downside, it's things that make sense based on what's going on in the world right now. It's luxury items, it's travel-related things. These all make sense, as well as pipelines. That's why energy has been hurt so much. And real estate is hurt here because of a lot of the REITs that have exposure to some of those particular themes as well. In terms of stocks that are moving, it's just worth paying attention to some of these different names. When you're looking at the stocks at the top of the scooter rankings, these are the top rated names. Things like Regeneron actually making a 52-week high today. So remember, and I learned this from years of reading Investors Business Daily, there are always stocks making new highs. And yesterday, I think, was one of the few days where you saw almost zero, but on most times, you have stocks doing well. There are a lot of staples names in here, things like General Mills, things like Campbell's Soups, things like Clorox. These are not normal names you would see up at the top of the scooter rankings, but here they are. Also a good dose of biotech, things like Gilead, Regeneron, also gold stocks. So Newmont Mining, gold was one of the better groups at times during the day today. In terms of big movers, again, I would encourage you to take a look. We don't have time to go through all of these, but there are a number of stocks that actually have improved really well. And again, with everything sort of up today, pay attention to where things are at relative to some key support and resistance levels. So when I'm looking at a stock like PBC, this is People's Bank. So financial sources above them, but this is, I feel a little better than that relative to some of the other patterns, might be thinking about. Finally, again, I would just encourage you to pay some attention to some of those names at the top of the return list, especially within the in the scooter rankings. And again, don't have enough time to go through those scooter rankings in the middle of the page there. We need to move on to our next segment, which is opening the final bar mailbag. So we love to answer your questions on what you're looking at, things you're asking about. And in this environment, I know there are plenty of opportunities to learn. And again, I've learned more from bear market phases in my career than I ever have from bull market phases. And that's the reality. So I hope, besides staying solvent and holding in return-wise, relative performance-wise as an investor, I hope you can use this stretch as an opportunity to learn. I did want to start with a poll. We asked you in the last couple of days on the StockCharts TV page, with the recent market volatility, do you expect that during the next months you will place more trades than normal, fewer trades than normal, or about the same amount? It was actually pretty fairly evenly distributed between the top two, between I'm going to trade a little more, I'm going to trade a little less, and 20% of you said about the same amount. So it was not really a polarized, hey, I'm going to trade a ton more, or I'm going to trade a ton less. It feels like people are sort of processing this, right? I think some are looking at this as an opportunity to trade around positions. Others are sort of holding and waiting to see how things play out, which is about right. I think that indecision that we see from there's no, one completely taking over, no majority answer there. I think that makes sense based on the environment that we've seen. I think that's the fair assessment of where people are at. It's more uncertainty than anything. So having said that, let's answer some of the questions that you've sent in recent days and recent weeks. Question number one. Let's see, we're looking at a chart of the US versus the whole world. This is a chart that I look at as part of my, part of my mindful investor checklist. I have a ratio that looks at the US versus the rest of the world. So we're going to bring this up. And the question in particular was related to this. The number one holding in that ETF is Apple. Is there a graph that suggests that compares the US to the rest of the world? What would a comparison of the two graphs add to your insights of what's going on with the overall market? It's a really good question. So this is the chart that you were sort of referring to, which is the one that I include in my packet, which is the SPY, the US versus ACWI. That's all country world index, and so that includes about 50% and then 50% non-US, 50% US, sorry, and 50% non-US. It includes emerging, developed, everything, all sort of in one big bundle. You can also look at the ratio of the U.S. market versus non-U.S. market. So it could be like the U.S. versus everything else. To be honest with you, it doesn't really change the ratio very much because it's a similar sort of reading, and both of those readings are certainly leaning more toward U.S. than non-U.S. That kind of came off today, but overall that trend has remained pretty positive. And I think, to be honest with you, that story in a lot of ways is the US dollar story. So if you look at a chart of the UUP, for example, or the US dollar index, UUP is a little better looking at the short-term movements, obviously, but the US dollar index is a great way of measuring. You can see this overall strength where the US dollar has been stronger relative to a lot of the other currencies out there. As a result, I think that is what is certainly helping to make US markets in general look relatively stronger than non-US markets. So I think that's the right ratio to look at, to be honest with you, and that's what I would be looking at. Certainly suggest US investors stay close to home for the foreseeable future. Question two, my question related to the max pain concept and how it affects us. Right now, March 14th, we're hoping for a reversal in equities and retest on the S&P. But how does max pain play into this reversal retest? Is it similar to options max pain? If you're not familiar, that's a concept. Maximum pain is dealing with options contracts, and there will be a option that would be the max pain. That would be the one that would cause the most pain on, the interest. If I were made, it's sort of what, where people have exposure to certain price level with here, but I would talk about sort of the pain trade, right? I think what I've often talked about with peers in the financial industry is the pain trade. What's the movement in the market that will cause the most pain to the most investors? Because then they tend to be very motivated to unwind position and to have fear drive some of their decisions. And that's where a lot of times there can be opportunity, because that'll manifest itself into volatile markets and movements that you can hopefully capitalize on. I think for me, when I'm thinking of pain in this market, the way that I would most think about it is what's going to happen if you look at this downtrend that we've had for the last 4 weeks now, right? 3 to 4 weeks. The trend has been, determinedly down, and that is totally fair, right? I don't think it's debatable. But if you look, individual days have been significantly big. If you look at today, up 5 to 6%. You look at Friday, up 9, 10%. Small caps up 12%. Those are big moves. And what happens, I think the pain is this. Those big days have a tendency to suck in a lot of investors, especially people really anxious to buy in at the bottom and not miss out on the next thing. The FOMO is a huge motivator. The problem is when you have a nice rally, it sucks in investors. You have another couple days, if we have a couple more days and we're up at 2650, it's going to feel like we won the lottery because the market's recovered so much. But look, we're still way, way, way below the previous highs. We are not in a bull market phase. There's still potential for downside. And I think the pain is when people get caught looking for an opportunity to gain on a short-term upside. Because then when the market turns back down, that's when the panic really happens. And that's the capitulation I think we'll see is we'll get out. I haven't seen that yet. That for me is going to be the biggest pain at risk, especially for individual investors. So I'd be certainly very, very cautious of that. Final question, pivot points and volume by price. We only have a minute left in the segment, so sorry, I wish I could get more to it. But, talking about things like pivot points, pivot points tend to be a very short-term indicator, right? And I remember spending time on the trading floors in Chicago, the CME and elsewhere, and guys would jot down the pivot points on an index card. That's what they've taken the pits. And those are some of the levels that they would use, just in the open outcry system, trying to identify price levels when they didn't have a whole charting mechanism in front of them, right? They would just jot down some of those particular levels. So I think if you're a short-term investor, they certainly have, at times been very widely followed. I think they're worth paying attention to. I would say that volume by price, that's a really good thing. I don't pay as much attention to it than I probably should. And anytime I'm talking to someone who uses this volume distribution, I always make a note saying I should use that more. So for what it's worth, I think you're onto something. And what it does is it shows you where there's a confluence of activity, right? What price levels have a lot of people executed a lot of trades. And there's a whole discipline called market profile that was designed by this guy, Pete Steidelmeyer, that's based on that idea that markets have a distribution, a normalized distribution, and you can take advantage of that. But for me, to be honest with you, you'll find I use very little volume in my work, and I think that's just one of those things that has worked itself out of my process over the years. So I know people that use that and swear by it. I think you're onto something if you're using that as a way to maybe validate some of the support and resistance levels that you're seeing on the chart. We're going to take a quick commercial break. That's our mailbag. And thank you again, everyone, for all of your questions. Be back with my guest, Tim Taschler, in a minute. Thanks so much. Hey everyone, welcome back to the show. This is Dave Keller at StockCharts.com. Please keep your questions and your feedback coming to us anytime you can. The final bar at StockCharts.com is the best way to get your questions and feedback in front of us. I want to welcome on my guest, Tim Taschler. Tim's a money manager at Sprott Global. based in the San Diego area. He's also a frequent contributor to our Top Advisors Corner. Tim, thanks so much for coming on the show today.
Thanks for having me, Dave. Happy St. Patrick's Day.
To you as well. So obviously
Thanks.
a lot going on. I'm so thankful that you're on the show to help us make sense of things. And in particular, we're going to talk about gold. We talked about gold on the show a couple times, recently, and yesterday we were actually talking about it on the show. And you actually made the point ahead of time about the importance of looking at the Commitment of Traders report. Can you walk us through this, and what is this telling you overall?
Well, when I came off the floor as a trader back in '86, it was one of the few things that we had to look at. And the Commitment of Traders report tracks what 3 or 4 different groups of registered traders are doing in the markets. And what you're looking at here shows the purple bars down below are showing what the commercials, the hedgers, what their net position is, and the blue purple bars up above show the large speculators. And the large specs are typically CTAs, commodity trend advisors, and then the hedge funds. So what you're seeing here is that the commercials were at a almost record short position in the middle end of February, and the hedge funds were at a record long position. And when you add options in with the futures, it was an even more long position on those from the hedge fund community. So what typically I'm watching is when I see these record levels, I am always concerned that these guys are so highly levered, 33 to 1 roughly on a gold contract, that when something happens in the market or just profit taking, they will liquidate. And when they do, you kind of get the moves we've seen in the last few weeks in gold, especially the last few days, and same in silver. So that's basically how I look at the COT. It's not a trading, it's not useful from a day-to-day trading perspective, but it does give you a big picture of where real money is positioned in the markets.
It's funny, as an equity guy, which is how I consider myself, I forget how much clarification you actually get on how people are positioned, which is very different than, the equities. It's usually speculation as to who's where. Here you actually have a window and people have to report where they're at. So it's actually really interesting. You get a sense of the supply and demand. Now, looking at the chart of the GLD, we're talking about the show, how you're just talking about with those positions, how does that relate to what we're seeing with the movements in gold now, rallying a little bit today?
Well, the one bad thing about Commitment to Traders report is it comes out on Friday afternoon, 12:30 Central or 12:30 Pacific time, and it ends the reporting session from the prior Tuesday. So we're always in a delayed situation, not really knowing what they're doing, but we can make some pretty good assumptions. And when we see the kind of liquidation you're seeing in GLD and in the gold futures and the severity and quickness of the drop, it's pretty easy to assume that a lot of these long hedge funds decided to sell, whether it's because they're in other positions and they're getting margin calls, or whatever the reason. I don't really care the why. I just like to watch the outcome, and that's what it looks like to me. And then we'll see in the next report on Friday, this coming Friday, we'll report the period when we've seen a lot of this move in gold up until today, in fact. So we should see a pretty big drop, I'm assuming, in how the managed money, the hedge funds, are positioned in gold. Same with silver.
This is really interesting stuff, Tim. And just to wrap up very quickly, if I could ask you a question. So based on that, a lot of people would traditionally think if you're seeing further downside in stocks, you're seeing a flight to safety, gold is one of those logical sort of go-to safe havens. Is that a fair assumption for investors to be making now, or should they think differently about how to be positioned in gold here?
Well, no, I think it's still a safe haven, but I think you have to pay attention to what big money's doing. And when you have historic moves in the market the way we are right now, it's unknowable what kind of positions they have in other equities or other futures, and hence there's forced liquidation. There's a lot of things going on behind the scene. It doesn't mean that gold is not a safe haven. It just means there's other pieces of the pie that are weighing on the price of gold short term.
This is so helpful, Tim. And again, I find with many investors and certainly many of our users, you get so comfortable in just analyzing the chart of gold and kind of making a decision. You're reminding us that there's stuff going on behind the scenes that can be really helpful to get color on. So I'd certainly hope people can check out your comments on our Top Advisors Corner, follow some of your thinking going forward. Tim Taschler, thanks so much for coming on the show. We really appreciate it.
Okay, thank you. Have a good one. Bye-bye.
You as well. Stay safe. Folks, that was Tim Taschler. Tim's from Sprott Global down in San Diego. Some great thoughts about gold and just how to think of it. And again, I've looked at gold and talked about it, but as always, I learn a ton from working with people and talking with people that are looking at other markets. And I don't pay as much attention to the commitment of traders. And when I talk to someone who does, Larry Williams is another one that comes to mind. When I've chatted with him, that's where we've tended to go. But you learn a ton. So some great thoughts there from Tim. We folks need to move on and wrap the show, and that means we're going to the 3 in 3. So at the end of every show, 3 charts in 3 minutes. My producer in my ear just said 3 minutes, so points for Dave hitting the mark so far today. Let's wrap the show, folks, with chart number 1, intermarket analysis. So, when I'm looking at each of these individual charts, I'd remind you, it's really good to have a chart like this set up, which is looking at all the different assets and how they roll up related to one another. This is pegged to the beginning of this recent bull market phase starting in December of 2018. In the black, you can see the S&P 500, and the labels you can see there toward the right side of the chart if you're not super clear on what's what. And you can see the big sell-off in here, and this has pushed stocks down to be one of the sort of middle of the road, halfway down the list of returns. So now looking at the last year plus couple months, we have bonds that have gained 30%, gold up 20%, stocks still up, but only about 9% off that market low, and the dollar up about 8%. And then at the bottom, we have the big loser. We have oil that's down pretty significantly, down here around 39%. So as a reminder, I think it's really helpful to just see how these moves have related to one another. It's interesting to note in bonds, obviously, with that huge extension upside, that parabolic move when stocks really started to sold off, now potentially putting in a lower high. We'll have to see how that actually materializes on the chart. And again, here's the dollar breaking to new swing highs, which is pretty rare in this sort of environment. So that's chart number 1. Chart number 2 is looking at that same group of 5 assets, but now I've added Bitcoin. So the one in black here at the top is Bitcoin. You can see at times Bitcoin has been way more volatile with way more extreme moves. So at one point, it was up 215% off of the lows from December 2018. But as you have now looked, that is completely unwound. And now it's right back with bonds. So if you'd bought Bitcoin and bonds at the same time at the market bottom, you'd be dead even. But one of these would have caused you a bit of stress. The other one would have been slow and steady with a healthy sort of total return profile. But I think it's worth noting, we talked with Julius DeKempener about Bitcoin when he was hosting the show last week. And, is Bitcoin a safe haven? Is it a flight to safety? And I think we see on the chart, not so much. The final chart on our 3 in 3 is the S&P 500 with up and down volume on the New York Stock Exchange. And this is a chart because it just visually shows you volume on up stocks and volume on down stocks, volume on advancers and volume on. It's just the expansion on both sides of this, right? So you can see the green bar is accelerating, the red bar is accelerating, and all that tells you is the volume has ballooned on both sides of the aisle. So it's not just people piling out of losers or piling into winners. They're piling into a lot of different things. And our poll question about doing more or less trading, I think this is why it sort of spoke to me, was because you've seen this volume extreme or this volume expand in a pretty meaningful way. And I think if that continues, I mean, it's just a very different environment than we've seen in recent weeks, if not recent years. So ladies and gentlemen, that is our show for today. For a volatile, as always, Tuesday here based on recent market history. I want to thank you so much for watching our show every weekday after the close to debrief on the technical stories of the day. Please keep your questions and your feedback coming. Send them to us at the final bar at stockcharts.com or look us up on Twitter at finalbarsctv. We answered your questions in our mailbag today. We'll do another one toward the end of the week. So really appreciate you taking the time to share your thoughts with us. For stockcharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.